Hey everyone, and welcome back to the Excellence Podcast, where we break down complex financial topics into easy to understand conversations to provide you with the absolute best education. Let's get into charts, the fundamental tools for understanding markets. Charts are the bread and butter of the trading world and are essential to one of the two major trading analysis types: technical analysis. Charts are where traders gather most of their pricing information and what they use to predict where prices will move next. As such, learning how to read charts is like learning the alphabet of the trading world. And while charts are an extremely in-depth topic, you can go deeper at your own pace. Today we're doing a lesson covering the basics, so it should be easy to follow, even if you're brand new to the trading world. There are two common types of charts. If you've ever seen trading or investing presented in a movie or other media, you've most likely seen a line chart. They are a clean and simple way of presenting price information with a single line stretched across the screen. This line represents the closing price at each data point. Like charts are great for getting a quick overview of price movement with a clear indication of the direction and velocity of the instrument you're looking at. However, candlestick charts are the ones traders most commonly use. They give more precise information, being able to show what exactly happened at each data point. This makes them a bit more difficult to read, but don't worry, we'll break it down. Each candle consists of three parts: the body, which is the thicker part in the middle, and two wicks, also called shadows, which are thin lines protruding from the top and bottom. The color of the body indicates whether the price went up or down during that data point. If it's green, the price increased, and if it's red, it decreased. This presents an issue for some colorblind traders, but most platforms allow you to customize these colors, so it shouldn't be much of a problem. The top and bottom of the body tells us the opening and closing prices for a single data point. If the price rose, the bottom is the opening and the top is the closing, and if it fell, it's the other way round. The wicks show the highest and lowest prices for a single data point. The top wick, of course, shows the highest and the bottom shows the lowest. If either wick is missing, it simply matches the opening or closing price and thus has merged with the body. We mentioned data points quite a few times already, and that may be confusing. That's where time frames come in. Time frames determine how long a period each data point will show. A 5-minute time frame means that each candle or point on a line chart will show data for 5 minutes. Time frames span from seconds to hours to days or even weeks, and each has a different purpose in trading. For instance, someone like a scalper who employs a super fast trading strategy will want to know what's happening right now and use a shorter time frame. Meanwhile, a position trader will want to conduct deeper analysis and get a feel of the price's history and tendencies. To cut out the noise, they usually zoom out on charts and use time frames that span hours or days. Before we sign off, we'll also introduce two chart-related concepts that are extremely important for technical analysis: support and resistance. Support is a price level where the market tends to stop falling and bounce back up. Resistance is the opposite, a level where the market struggles to go higher and often turns back down. These levels form because of trader psychology. Traders remember past market tendencies and get cautious at points where markets have struggled to grow or eager around their lowest thresholds. Identifying these points either by hand or with the use of tools is extremely useful, as it's an easy way to get an idea where prices will move next. Thanks for tuning into the Excellence Podcast. If you like this lesson, make sure to subscribe so you don't miss the upcoming episodes. Until next time.